Hi friends, welcome to the 5th video in our 6-part video series on hidden investor risks. Today, in part 5, what we want to focus on is the hidden investor risk around leaving a legacy. Most folks have at least thought about at some level what kind of legacy they want to leave, and that has everything to do with values as it does valuables. When it comes to your valuables, however, the IRS, your state and county probate court, and federal law dictate how that's treated. So depending on your asset structure and depending on who you're leaving your assets to, are they a family member? Do they live in a different state? Is it an institution? Is it a charity? Is it a private or family foundation? Is it a spouse? Are they children? Are they grandchildren? Are they minors? There are so many questions that go into not just who you leave your assets to, but which assets are you leaving them? The easiest way to understand it is there are good inheritances and then there are bad inheritances. For example, if you live in the state of California and you receive a retirement account from a parent or from a grandparent, you realize some of the highest tax rates in the country on those dollars because the Secure Act now deems that those accounts, those retirement accounts, must be liquidated within a 10-year period, and the liquidation happens on top of your regular earned income. So you pay federal taxes, state taxes, on top of the taxes you're already paying on your income, likely kicking most folks into something like the net investment income surtax. Whereas if you were to leave an individual a brokerage account in the state of California, it's taxed completely different. So as you're building your plan, whether you are a surviving spouse, whether you have no children, whether you're completely charitably inclined, or whether you're just getting started, one of the most important 2 questions that you can ask is, who do we want to leave assets to? And that can be an individual, an institution, a charity, or foundations, or otherwise. Who do we want to leave assets to? And then the work of which assets do we want to leave, because assigning the right assets to the right beneficiary makes all the difference in the world when it comes to how much do they keep. Going back to the example about a California citizen receiving a retirement account, if you also had a charity that you wanted to leave assets to, the charity would have paid no taxes had you left your retirement account to the charity. So making sure that your plan about leaving a legacy around your assets and wealth, you focus on who you want to leave it to and how you want to leave it, or which assets to leave it to. We work closely with family CPAs and attorneys to help build both an actual plan and then create a visual flow chart for you and your beneficiaries on where the assets are going. This is part 5. Our next and final video in this series is coming up next in Hidden Investor Risks. Thanks for watching. See you next time.